Good morning, everyone. Welcome to the Trading Coaches Playbook. My name is Brandon Wendell. I'll be your host for about the next hour or so as we dive into markets a little bit and basically take a look at some of the strategies that can help you possibly become a little more successful in your analysis. Obviously, no guarantees. And before I get started, I just need to let everybody know that we are not registered broker dealers or investment advisors. We're going to look at the markets, but we're doing it from an educational standpoint. So we're not telling you to buy, sell, or hold anything in particular. We're going to make personalized recommendations about those markets. While markets do involve the risk of loss, that is always a situation. We can never eliminate the risk. We just try to minimize and manage it. And we are not subject to trading restrictions, so we can have positions in securities or initiate them at any time. So good afternoon, everyone. Welcome. Oops. Sorry, I was getting a bunch of messages all of a sudden. And basically, we're pretty active here at Wealth Builders HQ, which I'm a part of. I primarily stay busy with what's called the E-mini think tank. And in the E-mini think tank, basically, I meet my students Mondays, Wednesdays, and Thursdays for 2 hours. We basically employ a lot of strategies that we got ideas in the markets. I'm sorry, we basically employ our ideas that we learned in the markets in the live market environment. And I do trade in a simulated mode just for legal reasons, but for the most part, we're looking at live data, real time, and actually employing a lot of strategies that I teach. With the E-mini think tank, it starts off with education. And if I go to the E-mini think tank here, you can see I can go to, there's a section that shows foundation trainings, and there's also a document which says start here. And basically, there's a heck of a lot of education, and it tells you kind of step by step how to learn this stuff. These are all self-paced courses. There are documents that go along with this, every single one of these lessons. And one of the ones we're going to talk about heavily today is something called divergence. And as I said, there's a full lesson and it's all self-paced education. So you can learn it as much as you want, review until it actually sticks. The more you actually watch the videos and the more you practice, the better off it is and becomes kind of a second nature piece of your tools to be able to trade in the markets. And pretty much we focus on futures, but basically what I'm talking about today when it comes to these divergences, that applies to any charting. Charting is charting. It doesn't matter if you're applying it to futures or if you're applying it to Forex or stocks. It really doesn't matter. And you can see all the charting techniques and the different fundamentals. I have documentation that goes along with it that students have access to. So it's kind of cool. If you're interested in joining the program, by all means, let me know. You can email us at support@wealthbuildershq.com. And there's actually a way you could try it out for free for 2 weeks. So if you're interested in learning more about that and the program and how to get everything for free for a couple of weeks, email us. Let us know. But basically, what it comes down to is we're going to talk about, like I said, indicators. Sorry, I was doing some other work earlier. And you know what? Actually, I don't want to mess with this chart. I'll mess with this one. There we go. And I've got the S&P up there. But again, this could apply to pretty much any indicator and any security. Let's see. So where was I here? I think I went through all the slides I wanted to go through. There's a lot of free online workshops that are available for us, for you, including Traders X-Ray next week. It looks like that's kind of cool. We'll have to check to see what that is all about. Trading Coaches Playbook every week and the Power Hour every Monday with Rob. But like I said, I'm involved in the E-mini think tank and a few other programs as well. So there's plenty of education for the markets. I've been involved in the markets for about 30 years now. I actually got my license as a registered rep back in 1996. And obviously, I don't have that licensing anymore. I mentioned that already. And you can stay in touch with us as well through all the socials, of course. But I started off as a retail broker and moved into back office operations. And it was kind of interesting with the back office operations. I learned a lot about something called price action and being able to read price action, more importantly. Learning how to read that price action taught me how to identify market movements or potential market movements. And that's kind of, part of what I did was continue my education. I don't believe education should ever end, especially when it comes to the markets. There's always new things you can learn. You can learn from the markets themselves. And of course, from your trading, both winners and losers. So there's a lot of education out there. Some of it's free, some of it costs you money, obviously. But ignorance typically costs more, as they say. You think education's expensive, try ignorance. But it's true. And one of the things I did is I got what's called the Charter Market Technician designation or CMT designation. I'm not sure how many there are right now. Oh no, CMT Association. There it is. Anyway, I think there's like 4,500 in the world, maybe more. I don't know exactly, but basically, oh, it says 2,500 CMT charter holders. Oh, so okay, so it's 2,500 plus. It's an exclusive group, but basically, it's kind of a master's degree in technical analysis. So it's a rigorous three-level curriculum. You got to take three different exams. It takes about 2 years to obtain the designation, and yeah, so it's been quite a journey, but I basically learned a lot about different technical analysis tools, and I teach this, simplified. Obviously, I try to keep it as simple as possible when it comes to trading, but I had to learn pretty much every single technical indicator that's out there. And you go out to these indicators and you can see, technicals. There are so many indicators that you could possibly choose from, and different strategies and patterns and all kinds of stuff. And like I said, I was fortunate to learn almost all of that. Fortunately, you don't have to because a lot of stuff works about the same way. And really, what it comes down to is indicators can be broken into two different um, categories, if you will. And the first category, let me move this out here, those are called oscillators. And the other category are momentum indicators. Now, one of the biggest problems, again, this is based on technical indicators. So this is kind of generalization of the technical indicators. But for the most part, that everything kind of fits into these one of these two categories. And oscillators oscillate around a zero line, or they, move up and down, kind of like an oscillating fan. It's got a pivot in the center and it moves both back and forth around that pivot. Sometimes the midline is zero, sometimes it's 50. It could be any number of things. So it moves up and down around a midline. And basically, they indicate when the price is overbought or oversold. So, sorry, I got something on my keyboard. Anyway, it kind of tells you when prices are technically overbought or oversold. And the theory behind that, actually, I'm going to change the momentum indicators to a different color to separate them. And even this, there we go. So we have it a little separate here. So again, they indicate whether prices are overbought or oversold. You might know some of them like CCI, stochastics, RSI, and there's plenty of others that fit into this. The KST, which is called the no shore thing, and several others. But basically, they move, and you can see I've got the RSI right here. It doesn't show, but there's the RSI that I have right now. And there's a line on top which indicates overbought situation and oversold at the bottom. And the theory behind this is that overbought may not last and prices should drop. But that's not necessarily true because when you're overbought, you can become more overbought. I mean, that's the nature of a bullish trend. Obviously, oversold shouldn't last and prices should rally. So that's kind of the theory, the working theory, if you will, behind using these oscillators. I guess I'm supposed to put a comment right there. Anyway, so yeah, that's an oscillator. It's basically moving up and down around a midline. It indicates where prices are overbought or oversold. So, like I said, I can put in other indicators I happen to have the RSI in there, but if I go to stochastics, oops, stochastic, either there's fast and slow stochastics. Let me go to technicals here, built in. These are extra ones that people have created. I guess I'll just use this one, and that's fine. And again, you can see there's a midline there at 50, and there happens to be higher and lower overbought, oversold sections. Same thing. If I were to bring in CCI, or now that's Constance Brown, that's something different. But you got the Woody CCI, Commodity Channel Index is actually the CCI. And this one, the center point is 0, and you've got 100 and negative 100 as the overbought, oversold situations or conditions. So that's one thing. And it's basically supposed to be measuring when prices are at extremes. So again, they move around and I should say they indicate price extremes, right? Because overbought or oversold would be an extreme. So that's pretty much it for oscillators. Now we have what are called momentum indicators, I mentioned. So put that right here, and we'll change the color. Spell that right. And momentum indicators. And they are measuring strength or weakness of the trend. Basically, the way our price movement. So they don't necessarily have an overbought, oversold situation. Yeah, I know, Trip. Trip saying I know a guy who uses RSI for momentum. I'm going to get to that. Yeah, absolutely. But let me move this over a little bit so the text shows up a little bit better here, and I don't run out of room. And there we go. A little better. So momentum indicators, again, they're measuring the strength or weakness of a trend and price movement. How strong is that price movement, bullish or bearish? Things like MACD, even moving averages. You got ADX, and there's a lot more. So typically, indicators would fit into one of those two categories. However, as Tripp was mentioning, he knows somebody that actually uses an oscillator as a momentum indicator. He's referring to me and possibly himself. But basically, yeah, you can actually massage or manipulate these indicators to work a little bit differently for you, possibly even better. So one of the things you got to realize is that, first of all, with all these indicators, the biggest flaw is the timing. What happens is with these momentum indicators or oscillators typically indicate a sell or buy signal when they cross that overbought, oversold situation. Or in the case of stochastics, which I took down, I probably could have left that there, but it's okay. Again, let me go to just the basic ones. There we go, stochastic. And you can see in the stochastic situation here, basically what it's doing is it's got two measurements. Let me thicken them up a little bit so we can actually see them. Trip said, best gold nugget he got from me. Thank you. But you can see that there's actually two lines. You got percent K and percent D. And basically what the stochastics, again, you got to know what they're measuring if you're going to be using them properly. And the stochastics actually measure where the current close is within a range. So in this case, stochastics says 14. So if I go into the settings here, you can see it's looking back a period of 14. And what it's doing is basically looking at the highs and lows for the last 14 candles and then measuring where's the current candle closing in relationship to that range. So if we were looking at the current candle, actually, let's do the last one because this one's already done. You can't necessarily use the current candle because it is not finished yet. And let me just do something here. Where is my line? Vertical. There we go. So, whoops, I want to do, let's say that one. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So there's the 14th candle back here, right? So basically what this is measuring here is the high and low. There it is, the high and low. And where's that candle closing in relationship to that high and low? Well, if you're looking at it percentage wise, that's probably about 40% of this range, right? This would be 100. This would be 0. Well, what's the stochastic reading right here? It's reading 39.63. That's pretty close, wasn't I? You can see where I marked it, 39.63. I said about 40%, basically just eyeballing where this close was in relationship to the low and the high. You look at charts enough, you get to kind of eyeball things pretty well. Now, what's happening is there's another line you'll notice that's right behind the orange line, and that is a smoothing factor, basically, and that's what it was showing in this setup. It was showing 14 periods is the range, and then you have 1, that's the percent K, that's the fast line. In this case, that's the blue line, and that's telling you based on where we're closing in the last 14 candles range. The percent D or orange line there, that's a smoothing factor, and it's smoothed by a factor of 3. So it's basically a moving average, a 3-period moving average of the blue line. That's all it is. So what they're trying to do here is, instead of just waiting for prices to come down and cross from 80 downwards, you actually get crossovers of those two lines, possibly signaling a little bit faster. And what it's supposed to be telling you, and same thing with this RSI. Now, my RSI is manipulated a little bit because it's not the traditional. First thing I do is I change the normal settings are 70-30 for overbought, oversold. Problem is, you'll notice when I look at my chart, 70-30 is kind of useless. It very rarely gives you a signal, doesn't it? Every once in a while, you're getting a signal, but every once in a while isn't good enough. Although you got to be careful, because whenever you're manipulating these indicators, for instance, if I change it from a 14 periods and I lower it down to say 10 periods, notice I get more signals, but you will receive more false signals. The lower the number you go for averaging, the quicker it'll signal and more sensitive it will be. Okay, it'll cry at sad movies. It's very sensitive. Now, but what happens is the more you speed up an indicator, the more sensitive it becomes, but you're open to more false signals. So it's kind of a trade-off. You got to be very careful with manipulating these and changing these. So I usually use the default 14 periods. However, I'm not using this, as I said, in an overbought, oversold situation. I'm actually changing the way I use it. And I'm changing this to 60 and 40. And of course, if you want to learn more about why I'm doing that, how I'm doing that, when you go into the foundation trainings right here in the E-mini think tank, you'll see I actually have a whole section right on RSI, a whole lesson on it. And not only is there a lesson, but there's also documentation regarding it too, and how to use things under fundamentals. Yeah, RSI rules right there. So students get access to that. Again, you can try it out for free if you're interested. Just email us or click the link. But anyway, getting back to the oscillators and indicators, I'm starting with oscillators first anyway. One of the big problems is that they're always based on the closing price, right? You take a look at the inputs here, and it says time frame chart, wait for time frame closes. You can even take that off. The problem is if you take that off, and let's go to a live security. Actually, I don't want to change this one because I don't want to lose the text. So I will move to this chart. And yeah, I'm on the ES. That's fine. I'm on a 5-minute ES. Let's go down to a 1 minute on the S&P futures. And I've got the RSI down below. So let's bring in that stochastic I was just using. Oops. Stochastic. There we go. And whoops. Bring it in so I can adjust this. Again, 14 period, not changing that at all. Just changing the thickness of the lines. There we go, just so we can see it better. And I'm going to remove this for now. Oh, actually, delete for now. There we go. And once again, if I go into the settings on the inputs, wait for time frame closes. I don't have to wait for the closes, and I'll actually get a little bit faster. Notice how it's moving. When prices move in the chart, you're seeing a little wiggle there. Very subtle, but it's happening. There it is. See how it's changing? The problem is the signal is not confirmed because this blue line could cross back below rather than crossing above like it did. If this were to change to a red candle before it closes, then this would collapse and that blue line would be below the orange line and not be giving you a buy signal. So technically, when you're using technical indicators, if you try to jump in now, you're getting in a little early, anticipating that it's going to finish this way, but it may not. We might actually get completely sold off within the next minute and have a red candle with the crossover to the downside rather than the upside. So in order to use most technical indicators, they do not confirm until the close of the candle that you're currently on. That means no matter what indicator you use, you will always be delayed by whatever time frame you have your chart set for. Now, granted, it may not be a huge delay, in this case, 1 minute, or I can go to tick charts or even what we call shared charts. And in this case, it was a nice buy signal. It was going to the upside. It finished that way. But now what's happening is we're starting to push back down right away. Now, again, we're on a 1 minute time frame, so a very small time frame in price, but you get the point. The point is that every technical indicator, for the most part, is based on past closed price. So it will always be delayed by whatever period you happen to be trading on. So we got to be careful with relying on buy and sell signals on all these indicators because, again, they're going to be late. However, there is a way of looking at these signals that's not delayed, and that's what I'm going to be talking about today. Divergence is a way of looking at these indicators possibly before the candles close to give you a little bit faster of an indication as to what's actually happening. So let me go, actually, I'll go back to that other one. Now, first of all, what is a divergence? What the heck am I talking about here? Well, we're talking about the indicator doing something different than what price is doing. So again, let me go to is this mine? RSI? I put it in too many times. Didn't mean to click it that many times. Yeah, this should be it. I'm going to edit. There we go. And thicken the line. Let's see, that might be too thick. Nope, that's good. 60/40, and we're good there. So again, I'm using the default RSI, which is 14 periods. But what I have done is change my upper to 60 for overbought and lower to 40 for oversold. And the reason why I'm doing that is to help me identify the direction and strength of a trend, because 70/30 doesn't work. I'll just leave it at that. Again, if you want to learn more, E-mini Think Tank in the foundational training, I've got the whole big thing about that. So today, again, I'm just talking about the divergence. So we have actually 4 different types of divergence when it comes to any indicator. Again, I prefer to use RSI. For a while, I was only using CCI as an indicator. That was my favorite for a while. But again, it changes. You change preference based on what works for you. So we have divergence. And that is indicator moves differently than price. And like I said, it could be on any security. It could be on stocks, could be on options, could be well, it could be futures, stocks, forex, indexes. Options are on those things, but you could trade those based on what you're getting on your indicators. So with divergence, we have 2 pieces. Obviously, we have price, and then we also have the indicator. Change the color. Not that. There we go. And actually, let's change the price of that, or not price, the color. So we have price and the indicator that may be doing something different from each other, and that would be a divergence. So, like I said, we have a couple different types of divergence. One would be if price is moving and making new lows, typically in a downtrend. but the indicator is not doing the same. I'll leave it. No, I want to change the color so they're different. There we go. So what we see in this case is price is making a lower low. The indicator is making a higher low. It could be the same as well, same or higher low. Now, this indicator is either measuring momentum or it's measuring oversold situation in this case. Well, here we were oversold. Even though prices went lower, we're not as oversold as we were. Or as prices are making a new low, we don't have as much bearish momentum as we did before. Either way, this is an indication of what we call positive divergence. Why is it doing that? Sometimes it's also called bullish divergence, just so you know, because it indicates prices are likely to start moving up. Now, one of the things I want to caution you about is with these divergences are warning signs. They still need to be confirmed in order to be able to actually recognize that trend is changing. And we can actually use these divergences on different time frames as well. So, in a way, they're very, very versatile, these indicators, again, if you know how to use them correctly. So, for the trend, and basically when I trade, I should also take a little step back here. When I trade on multiple time frames. I'm looking at a minimum of three different time frames on any security I'm trading. I'm looking at my zone time frame where I'm making my trading decisions on when to enter and exit, and that's my zones. When I also look at a trend time frame, which tells me which direction to be trading. Are we in a bullish trend? Should I be buying? Am I in a bearish trend? Should I be selling? Are we sideways? Should we be doing both, or maybe doing some time decay opportunities? Excuse me. So on the trend time frame, divergence is a warning of trend weakness. Now, that's a warning signal only. It still needs to be confirmed because trend weakness could be a pause, not a reversal. So you still need to get a confirmation after that. And again, the confirmations are not the divergence itself, but something that comes after that divergence. What is it, you ask? Well, if you join me in the E-mini think tank, I'll tell you. Anyway, on the zone time frame, basically the divergence helps us to, whoops, yeah, whether to act or pass. So what happens is, in this case, if I get a positive or bullish divergence on my trend time frame, that's telling me the bearish trend that we're in, making lower highs and lower lows, might be pausing or ending. If I'm seeing this positive divergence on my zone time frame and we happen to be at a demand zone, that's telling me I'm more likely to actually take the action and buy rather than passing on it. If I don't get the divergence, I may not take the action. So the zone and trend time frame, those are ones that you have to choose based on what type of trader you're going to be. And typically what I do is, what happened here? Oh, it went up there, snapped. That's why. Hold on. There we go. For time frames are related by a factor of 5. So again, it's kind of up to you what time frame you actually want to use. Some day traders might be using 5-minute charts. Some might be using larger time frames. So actually, I want to change the color of this one too, so it stands out differently. There we go. So in this case, I might be using a zone time frame, trend time frame, and my perspective time frame, which tells me where the trend's going to end. So I might use, say, a 3 minute. Well, then I'd be using a 15 minute because that's times 5, right? And I might be using a 60 minute. Now I know that's not a multiple of 5. I'm sorry, it's not a multiple of 5, it's 4. But you kind of fudge it sometimes. You want to stick with common time frames. If I'm trading on a 5 minute time frame here, I might use a 30 minute, which is times 6. And then I could use a 180 minute, 3 hours. That's times 6 again. If I'm using a 15 minute chart, maybe I use 60 minute. And then I can use 240 minute, and so on. It's depending on what you want to trade and how you're trading it. Swing trades, maybe 60 minute. Then I'd use 240 again. And then daily. Starting to run into each other here. There we go. And maybe even daily, weekly. That's 5, and monthly. So there's a combination that can be used for pretty much anything you want. It's just a matter of figuring out what works best for you. Depending on if you're a day trader or long-term swing trader. That's all. So move this over a little bit here. Anyway, so actually I can't. I'm going to need the room. So there's the indicator and price. That's a positive or bullish divergence. That usually signals weakness in a bearish trend. Okay. Hello, everyone. Yeah. Welcome. Welcome, John. And Kevin and Brenda and everybody else. So we also have what is called, actually, I'll just copy this one. Negative divergence. Or bearish divergence. And again, it's very simple. It's going to be price, in this case, moving up and making highs. However, the indicator is doing the opposite. So I'll do it this way. Oh, what happened there? So in this case, perhaps the indicator is making the same or lower highs. Whoops. There we go. Oops, forgot to set that first. Now I can copy it. So again, what we're seeing is that even though we're making a new high, we're not nearly as overbought as we were before. The conditions have changed. Or if you're reading a momentum indicator where price is making new highs, we're doing it with less or the same momentum as the previous highs. In order to maintain a trend, you should be seeing increased momentum, not decreased. And it's interesting, we're actually seeing an example of divergence right now because you can see on my chart, it happens to be a 1 minute chart, but price is making lower lows right there, but we're doing it with less momentum on the RSI. The RSI is saying, well, we're moving down, yes, but we don't have as near as much momentum to the downside as we once had. And that's not sustainable. Next thing you know, prices start to rally. This will actually happen. This indication with divergence will actually occur before you get crossovers for buying and selling signals. Again, for that RSI, if we were using the RSI as traditionally expected with 70 and 30, the buy signal didn't come until here when we crossed back up above 30. When would have been the best time? And by the way, it's not on that candle because remember, that doesn't happen, that crossover doesn't happen until this candle. So you wouldn't have been able to buy until here, roughly. The best time to buy would have been down here at the lows. That's a 6 point difference. That's $300 difference in price. And that's just on a 1 minute chart. If you do that on a daily chart, it could be thousands of dollars of difference. So it really is important to get in at the right time, obviously, based on what price is likely to do and seeing the right indications. So divergence happens much, much sooner than crossovers for buy and sell signals on any indicator. Like I said, I could use a MACD instead of this or a CCI or whatever you want. It's always going to be showing divergence first before you get to see any other kind of indication, like a buy or sell signal. So I mentioned there's actually four different types of divergence. There's actually also what is called hidden divergence. I'm running out of room to type. Let's see. We can delete this stuff. And it's kind of the opposite in a way where we have, let's see, price. Wrong one. Let's see, price. Oh, again, forgot. Snap is on. So price is moving and failing to make new highs. So maybe it's making the same highs as before. But the indicator is actually making fresh highs. I'll put it this way. And this is kind of the opposite, obviously. So again, what's happening is that price is making new highs. The indicator, price is not making new highs, but the indicator is. This should actually be under the negative side. This is what we call hidden divergence. So I'm not going to be able to move the whole thing over all at once, unfortunately, but this would be hidden divergence because price, as I said, is failing to break out the new highs, even though the indicator is saying we have more momentum. So because we have more bullish momentum but failed to break out, that means there's a lot of additional selling pressure here. And anytime an indicator is doing something different than price, that's a divergence. They're diverging, moving in opposite directions. And like I said, in this case, we have too much momentum, but we're not going anywhere. We also have positive hidden divergence, where price might be moving down. And failing to make new lows, even though we have more momentum, right? So if we have good momentum, we should be making fresh lows if you have more bearish momentum than you had before. There we go. And once again, the indicator is doing something different than price. So unfortunately, I put them up, not next to each other the way I should have, but let me change this to, let's see, can I go to a 5 minute or 10 minute chart? Trying to get the price out of the way. That's not going to help as much. It was worse. I was trying to get price instead of it running on top of the drawings. That's okay. It is what it is. But you can see that positive divergence here, prices failed to make a new low, even though we had more bearish momentum. And therefore, we're likely to see there's a lot of buying pressure that's hidden here that's going to push prices to the upside. So basically, if I want to use this, I go out to my charts. Oh, actually, there's one more thing that I have to mention before I go out back out to the charts here, which is kind of important. How do you know we made a price higher, price low? Right? Because you don't want to go with every single candle. If you go with every single little candle, you go crazy with trying to figure out divergence or not. There's a high, that a high, is that a high, is that a high? Well, we need to define what makes a high or what makes a low in order to be able to call it divergence or if prices are diverging. So basically, what's happening is when I say divergence, that means it has been confirmed, the candles have closed, and we actually have a divergence that can be taken action on. If we are diverging, it means that currently the picture is such that it looks like it's going to finish that way. But remember, until the candles close, it's not confirmed. But even when you're waiting for divergence, that signal will happen if you wait for the close before the crossover signals happen. So how do we know when we're actually making a high or a low? Well, basically, for a price high, it's a price high that kind of stands out. It's not just one candle higher than the previous one, things like that, but it's a high that kind of stands out. And specifically, the candles around it have to be creating a lower high and lower low on either side. So believe it or not, here is a price high right there because you'll notice there's a lower high on either side and a lower low on either side. It doesn't have to be the very next candle. But this was a point where prices were moving down and made a high that can now be recognized as, okay, are we doing some sort of divergence? Are we in a trend? This is also for helping define what a trend is. You must have lower highs and lower lows, higher highs. Same thing for a price low. It's when a low stands out, first of all, on a candle with a higher low and higher high on either side. So as we're moving to the downside, this one, remember I pointed out a divergence here. That is a low in price right there. There's a higher low, higher high on either side. That one's not, right? Shouldn't be using that as a low because, again, we don't have a higher high next to it. We have higher lows, but we never made a higher high there. That one actually could be considered. At the time, again, we're looking at candles as they're being formed, right? So right here, we see this candle formed. Then the next candle, unfortunately, didn't make a higher high. That's not a low. Price makes another new low. That's why we want to wait for confirmation before we consider it to be a higher low for technical reading purposes or analysis purposes. Well, the next candle, boom, that one's done. Now we actually have put in a low. We see that there is a divergence where prices made a new low. The indicator did not. Again, this is on a 1 minute time frame. So this I'd be probably trading on, not using for trend, but it works the same way. I'll show you when we go to trend as well. And unfortunately, it continued to go a little bit lower. So again, it's not perfect, but it can go lower. In this case, now there's another new low. And we can see that the indicator is actually higher, so there's no more divergence. The divergence was here, just that part that I marked, unfortunately never confirmed. And we eventually started reversing. And here we ended up making a higher low. Actually, I need to change that from 70-30 back to 60-40 for me to use it. There we go. But basically that's what tells me whether or not I have a price high or low. It's a low or high that stands out in the area. And specifically, we got to have higher low, higher high, or lower high and lower low on either side. So let's see, I got a question here. When it comes to leg out, some people say one explosive, some say two decisive candles. I basically, yeah, it depends on what they're looking for. I'm trying to kind of codify my supply and demand. That's what the question's about is supply and demand. And basically, I'm looking to see the overall move out. If explosive moves with large candles are definitely better, however, they're not always available. So for instance, right here, we have a little drop, base, base, and then there's a not really explosive move, but it is a move out right there. But for me, that's not going to be a good demand zone, at least not what I'm going to trade on. And here's the reason why. Okay, it looks like there's a good move out, but there's only one new high after the leg out candle. There's no real follow through there, is it? And we had trouble breaking out above prior highs. We kind of have this movement with the impulses here. And you can see that we failed to take out this high before retreating. If this one candle had taken out that high, if it was a really big green candle, then I probably would have used it for a demand zone. But because, yeah, it was a turning point in price, we did have lots of buying pressure there. That's likely to cause a pause in price, but not actually bounce as demand. What happened? Caused a pause in price, but we went through it. And also, we had too much bearish momentum. So we were likely to break through that. So I actually have, like I said, with my indicators for supply and demand, I have a video on that as well, specifically how I look for those zones. And where is it? It's in I know it's in one of the videos. I can't remember which one it is. It says in the start here, but when you go to fundamentals right there, my leg-based zoning technique, I actually kind of codified exactly what it is I'm looking for when it comes to what the zones are. And also, let's see if I have it on here. Is my trade station open? I can't remember. Oh, it is. I'm not sure if I have the indicator on here or not, but I have studies written for that as well. Base candles. I think this is one. Let me see if that works. Nope, that's not. What is that doing? Studies? Had it. That's weird. Base candles. No. Customize. Oh, scaling. That's what I wanted. Let's see if it works. No, the indicator's not working right now. So that's why I was trying to bring it up on my toss. I have to work on that indicator, but I do have an indicator that basically signals what I'm looking for supply and demand and how to identify them. It actually color the candles blue when there's a certain area. All right. And it's not perfect. I'm still working with AI and coding a lot of things. And I have Claude as well as ChatGPT writing codes for TradeStation ELDs as well as TOS writing it's not Pine Script, that's TradingView, but I've got that too. So I'm working with all those with AI and coding all those. But yeah, I mean, I have specific rules that I use. And again, I teach those and have documents on them, and we practice it in real time in the mini think tank. So actually, let me go back to there it is. Wrong one, sorry. Charts. And it probably slowed down my computer dramatically just now by doing this, by opening this up. So let me close out TradeStation for now. Go to all. There we go. And that'll speed things up here. And yeah, you'll notice that some of the candles from time to time will be colored blue, like right here. And the reason behind that is that may be identifying a zone for me. And you can see this one looks like it's a really good zone, again, based on a very powerful move out. But like I said, I've got specific patterns that I'm looking for, and this one wasn't tested yet, not even close. And sorry, these lines are in for a reason. We were doing some analysis for a strategy that I created that I'm testing right now using using Claude AI as well. But where was I? Looking at indicators and looking at the divergence. I want to stick with the same topic because we're almost out of time here. Of course, if you have any questions regarding this divergence, please let me know. But if we were to go to, let's see, there we go. I'll stay with this and maybe look at Euro USD currency on, let's do an hourly time frame. Okay, basically just pulling back in time, random. I happen to have the RSI here. Again, that's one I use pretty heavily. And if I'm looking at this on a 1 hour time frame, right? I'm on a 1 hour, that means I'm probably trading on a 15-minute time frame. So the 1 hour would be my trend, and I'll be looking for those indicators to tell me, or indications to tell me when prices might be pausing or changing direction. And there's a positive divergence. And this one, I wouldn't necessarily call it a divergence because that's not really a low, is it? Remember what I just said, for lows and highs to be registered and used for trading purposes, you really should be seeing, in this case, we didn't get it. It's going on direction. You need to have a low with a higher low on either side and a higher high. Well, we never got that there. So that would not technically be a divergence, and I would just ignore that. But what happened? We got a little bit of a pullback, but overall, the actual divergence would have been, see, there's a low, right? Because again, you have low, higher high. And then when do you get another experience of that? Right here. And here. Well, from here to here, we actually made a higher low in price and higher low on the indicator. So there's no divergence. However, here, now we actually do have divergence, don't we? And what happens immediately after that divergence? We started breaking out to a new high. So it warned us that the trend was getting weak. That downward trend was getting weak, even though we haven't had an uptrend yet, because an uptrend would be higher lows, higher highs. So we started breaking to the upside. There's actually a peak right here as well. Whoops, wrong one. That one. And this is also telling me something. We could not get into bullish territory when we made a peak. That means we're not out of the woods yet for the bearish trend. So we never got confirmation. And what happened? Well, right through here, we got high right there, lower high, lower low on either side. And we were actually below 60 when that high was formed. So again, showing bearishness, not bullishness, even though it broke it just before when the high was actually being made. And even here, there's another high. What's happening? Higher high, lower high, negative divergence. And what happens? Prices are starting to move down, aren't they? The bearish trend is continuing. Probably should pull it back like this. That's where you would know that's a high. As soon as this candle made that lower high, it started making the lower low. So now you're getting signals that prices are likely to start dropping or at least stop rising. And sure enough, that was the peak that was put in there. Here's another confirmation of trend weakness. A high in price, lower high, lower low on either side. Can't get above 60. And what happens? Prices break down to a fresh low, don't they? Let's see when this might be ending. Well, we're putting in a bottom right here. Let me zoom in a little more. Oh, not that much. There we go. And we actually had one right here, right? Because you have higher low, higher high on either side. And right here, higher low, higher high on the other side, but looks like momentum and trend are still intact. They're moving down. So no sign of weakness yet. Now, let's see what's going on. We don't actually have a bottom in yet, even though we do have less momentum. So prices are diverging where they're moving down to new lows without the indicator doing it, but we don't actually have a divergence because that was not an official low that was created. Remember, you got to have higher lows and higher highs around it. Let's see what happens. Now we finally got the higher lows, higher highs, positive divergence. Obviously, it's a little late in this case. Indicators are always going to be lagging, even with the divergence, but typically the signals will come faster than when you're waiting for crossovers and things like that. So it looks like the trend might be ending. It hasn't confirmed yet, though. And still never confirmed. Without the confirmation, look what happened. Prices actually made a new low. We never got confirmation. As a matter of fact, we saw trend weakness again. Why? There's a high, lower low. Can't get above 60. Can't go into bullish territory. So I use this on my trend time frame to let me know what's going on with the trend, but then I also use it on the zone time frame to let me know whether or not I'm buying or selling to take action. Yeah, I use them in both. I think I mentioned that was in the notes here. Yeah, right here. So on the trend time frame, it lets me know if the trend is likely to pause or reverse, but it has to be confirmed after the warning signal. And again, if you want to know all the details of it, again, try out the E-mini think tank. You can try it out for free for a couple of weeks, get all the details there. The zone time frame is when I use it. I use it on both. And divergence on the trend time frame warns me of trend weakness. On the zone time frame, it lets me know whether or not I should cancel a trade. As a matter of fact, in the E-mini think tank, let me see. I put out trade ideas every single class. So for instance, we have, let's see, I'll go back to 12th. And what happens is I send out as well as show in the class. You notice right here, I have class recordings. So if you can't make it live to class, you can watch a recording. But right there, there's also a trade tracker. And what happens is every single session I put out this trade idea page. Well, it's PowerPoint, so it goes out to everybody. Even if you don't make it to the class, you get it emailed to you. And what happens is on this page, I have cancellation criteria. Why would we cancel a trade and not take it? And then I put out anywhere from 4 to sometimes 10 trade ideas, and they're on different time frames. Right now, we're on this one, soy oil, May 2026, 4-hour time frame. We had a long that was open. Unfortunately, we had a loss on the smaller time frame, but it hit the higher demand. That was a 60-minute. Sometimes they're on 15 minutes. This was actually quite a few larger time frame trades, but most of them weren't taken because any means no entry. There was a reason behind. Either we hit target first or the RSI was too bearish in this case. And there was a rollover of the March contract. That was a loss. That's open. And basically, oh, I forgot to show you that too. You get the trade ideas, and I have a legend as to why I use certain colors for the different lines. You get to see what I'm looking for, what defines a zone. So what happens is every single day that we get together, Mondays, Wednesdays, and Thursdays, even if you can't make it to the class, you get these examples that point out what am I looking for a zone? And they all follow the rules that I've been teaching inside of the E-mini think tank. So you get to learn what I'm looking for specifically with all the details and the documents that back it up. And then you get to practice it in a real life environment as much as you want. So that's kind of cool stuff there. Anyway, I got to get running. That's it for me for today. Actually got set up for some trades I'm going to be taking in a little bit. So I want to thank you guys for spending some time with me. And again, if you're interested, you can click on the link that was put in there. Alyssa put in the link for the E-mini think tank. And right here, if you click on the get started, you can see there's a 2-week free trial if you do quarterly subscription. We don't charge you up front, so you can try it out, kick the tires, so to speak, try all the different documentations, all the stuff, and see if you like it. And if you do, stick around. If not, it doesn't cost you anything but your time. So again, thank you for being here, and trade safe, trade well, everyone. Take care. Before I forget, if you have any more questions, you can email us as well, support@wealthbuildershq.com. If you got any questions you forgot to ask while you're in here. So take care.